Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about impact investing, particularly measuring its impact with precision. Arsalan Mahtafar leads JP Morgan's Development Finance Institution. Its mission is to channel private capital to investments with a developmental impact. And I'm pretty sure from my research, it was the first of all U.S. banks to do this. Now, Arsalan was right at the middle of this because he worked with the development banks to create JP Morgan's DFI methodology. Previously, he worked with governments through McKinsey's economic development practice, where he advised countries on their growth strategies. Arsalan got his bachelor's from UC Berkeley and his master's in international development from Harvard University. So, Arsalan, welcome to the podcast.
Thank you for having me, Rob.
So impact investing is challenging, to say the least, in many respects. But developing a methodology for determining impact is hard and can take a long time. So how do you and your team accomplish the measurement of impact?
Well, Rob, I think impact investing, as you mentioned, is really hard, but it's especially hard to do it in capital markets and wholesale banking. Most of the impact investing you probably see out there is done by private equity firms investing in social enterprises, and they take a board seat. They're much more in touch and engaged with the management of the company, and therefore they're able to probe a bit more. They're able to collect data much more, and they're able to kind of steer some of the decisions of the management in order to achieve more impact. But the problem with that is that it can't scale beyond a certain amount, right? The private equity space is a limited asset class, and there's billions of dollars that, for instance, in developing countries are invested through private equity. But if you really want to address kind of the global challenges that we have, you need to be able to mobilize money from the institutional investors that are active in public markets. And so that's what we really set up to do with the JP Morgan DFI. Another thing I'll mention is that when you go into the public markets, there was already an existing asset class named ESG as I wouldn't know, maybe call it an asset class, but at least as an approach to investing, which is distinct from impact. ESG was much more internal facing, looking about how an investor can reduce exposure to companies that present environmental, social, and governance risk with the way that they typically do their business, versus impact, which is searching for companies that produce measurable social and economic and environmental good in society. So it's a much more output and outcome oriented thing. If you look at kind of the assets under management that we're looking for impact in public markets, the easiest places they could find them were for climate. Climate impact is much more easy to identify if you're investing in a renewable energy company, if you're investing in, energy efficiency and, electric vehicles, all of that. It's a little bit easier to kind of find the impact thesis there. And that's why we see a lot of sustainable and impact assets under management in public markets, mainly going to developed countries where there are much more larger pipelines of such climate finance type of projects, and much less in developing countries. So we thought if we were to measure not just impact, but a specific flavor of impact called development impact, defined as helping improve the quality of life of people in developing countries, reducing poverty, reducing inequality, providing access to basic human needs, we need to consult with the people who have been doing that for many, many years. And they happen to be outside of Wall Street and be in the official sector, where official development institutions, publicly owned, organizations like the World Bank and Asian Development Bank and African Development Bank have been using methodologies for decades on how to measure development impact, and learn from them and create an approach to be able to apply it to capital markets that are being channeled towards developing countries.
Okay, well, see, you made it sound like a little bit less of a daunting task than it probably was. You made it sound real easy. You just go to the development banks and take what they did and then just build on top of the capital markets. That was a half a sentence. How long did this take you?
So that took near a year-long effort, because you're absolutely right, Rob. They are a different beast. I mean, the development banks themselves typically have one or two main products. They either lend or they provide some direct equity investment. We in an investment bank have a long list of products. We advise on M&A. We underwrite debt and equity. We syndicate loans. We, do custody and fund services. We do, derivatives that hedge risk from commodities to FX to interest rates. So there's so many more things that we as a investment bank do. And there's also a different life cycle to a capital markets transaction and a public deal than to the kind of private direct engagement that a development bank does. But I think we had one thing going for us as an investment bank is that we typically are the ones that are doing due diligence on an entity before we help them raise capital in the public markets, and we could use that capacity to do not only due diligence on the financials of the company as we normally do, but now do due diligence on the development impact. And essentially adapt and adopt the methodology in a way that in that capital markets life cycle can provide that information for the benefit of impact-focused investors. And then the other task we do as a investment bank is then to distribute those assets to institutional investors and essentially market that asset to a range of portfolio managers and that are searching for assets that have both financial returns and positive impact. And there, again, it required a lot of, I think, socialization of our methodology to be accepted that a transaction that on the surface, it's not climate finance. It's not necessarily something that just has an environmental perspective, which was an easy thing to check the check boxes of a sustainable or impact investor. But then to show that if it's gone through a methodical diligence and has a development impact thesis, it should also be eligible for a sustainable portfolio. And that required many, many additional years of time to socialize that with the private institutional investor community to get that consensus.
And was there much in the way of, as JP Morgan is a GSIB, and one of the more regulated organizations on the face of the earth, not that I'm not talking about airlines or airports, but pretty close, right? Was that also a factor in how you built the methodology, or was there already enough? You all have lots of methodologies, so was there already enough work done on that you could get it into there?
I think the methodology part was a little bit more a marriage of doing something that is both, rigorous and technically correct, but also practical within the time frame and within the situations in which we operate. That was for the methodology. But then when implementing the methodology, Rob, you're absolutely right. Being a highly regulated organization, anything that you're doing that is in any ways new in a bank requires layers of work that you need to do with different functions in risk, compliance, controls, legal, and to build an infrastructure that allows you to do something that is relatively novel for a financial institution. So we went through all that and created, a lot of the rules of the roads and the compliance. And we also showed that at the same time, something that we're doing, if you again kind of take the, a few steps back and you look at it from a little bit further, holistically, is not that different either from what is our role, which is mobilizing capital from, people that want to invest their savings to people who need it for, growing their business. It's not that different from our role of, an underwriter and doing the due diligence and presenting the investment opportunity. It's just an additional layer on top of that adds the development impact assessment and broadens the outreach to impact-focused investors.
Okay. So not to talk about all of Arsalan's headaches, but let's talk about one of the other headaches. You mentioned it earlier, scaling.
Yeah.
So how has that evolved? How did you all handle that?
So first, it was a lot of Zoom meetings back to back all day, every day, with, both sides of the equation. And I think, as a capital markets intermediary, on one hand, our clients are those that want to raise capital. These could be both companies as well as sovereigns, whether it's local governments or national governments, to tell them, what the process is, what it entails in terms of effort and in terms of time, and what the benefits would be. And the other side, to the investors, to share with them, what the methodology and the process is and how that might satisfy certain impact and sustainability criteria they have. So that required a lot of socialization with those two client sets, required a lot of internal socialization with our bankers, because we are a relatively small team, but we cover 80 countries,
Right.
right? And
Most of the world.
and the way we do that is that, JP Morgan has offices in, 80 of the, lower to middle income countries. And so we can cover all of our clients in those geographies through our bankers, educating our bankers on when it would be appropriate to pull us into a deal, how they can pitch our capabilities to their clients. We can join some of those pitch meetings as well, but through them we could help socialize this with a large client set, as well as on the investor side with our sales organization, which again covers all of the institutional investors across the globe. Here, it's mainly in developed markets in the U.S., Canada, all of the European countries, Nordic countries, all the way out to Japan and Australia, where there are also pools of capital that are seeking both financial and social returns. So those are kind of the providers of capital, and the users are in the low-income countries. But after that effort, and after doing that for about 3 years, we launched in January in 2020, and then in April of 2023, we actually convened a industry working group comprised of 10 of the largest investment banks, folks like Bank of America and HSBC and Standard Chartered and Deutsche Bank and Natixis and SocGen. So those folks, some of the largest institutional investors that invest, especially in emerging markets and sustainable investing in emerging markets, like Amundi and AXA and Goldman Sachs Asset Management and Barings and CDPQ. So we brought all these. So we brought some of the development banks again, Asian Development Bank, the French Development Agency, the U.S. Development Agency. We brought in industry associations like ICMA as an observer, the International Sustainability Standards Board, ISSB, as an observer, UN agencies that focus on international development, and we put our methodology again on the table, and we said, let's think about how can we make it better, and how can we make sure that it addresses everyone's best thinking and ultimately everyone's criteria for sustainable investing in the emerging markets in a way that we could again scale this up. Because no matter how much we do it as just JP Morgan, and we're the largest bank in the world, but we're still less than 10% of market share in securities underwriting and sales. And so if we want to meet the challenge of global development and the trillions of dollars are needed in order to finance it, we need other people to engage with this space and to in many ways replicate the approach that we had been doing. And just in a few weeks, we will be publishing the final version of the guidance that is coming out of this working group that has been working for about a year and a half.
So everyone, point your web browsers over there. It'll be 2 weeks when you, roughly 2 weeks when you hear this podcast. I guess one of the things that I'm curious about is I would guess that for all of those people that you brought together, one of their biggest sticking points is probably due diligence.
Mm-hmm.
It's complicated. It's a lot of work. It's expensive. And then you had a lot of places you don't have a lot of benchmarks.
Right.
Is that fair, or were there other sticking issues that they had?
I think that's true, but I think the problem, if I kind of double click into that, is that there's not a standardized approach for how to do that due diligence. Right. And when you don't have that, even if you do the diligence, but then someone says, okay, that's interesting information, but it wasn't the information I was looking for. I was looking for this set of criteria. Right. And do you have any info on that? And they're like, no. And then you go to another investor and they have a different set of criteria. And so a lack of standardization in the industry is the best, the biggest constraint to scale, right? And so when we brought this group together and we, deliberately brought kind of equal representation from the sell side and the buy side, was to say that let's agree on a common set of standards of how we measure development impact on the sustainable development goals in these kind of public markets, so that the buy side agrees that yes, if disclosure exists in this format, following this methodology, following these kind of set of criteria, then yes, we agree that it will be eligible for our sustainable portfolios. And then in many ways, the sell side has both the kind of guidebook on how to do it, but also an incentive now to go through that process and spend that additional time and money and effort that it is, because they know that doing so would expand their reach to trade and sell to a broader pool of institutional investors. So that kind of collective action problem was in many ways addressed by bringing these groups together.
It's fascinating. So that's one of the major issues. Could you talk about, from your perspective, what the other trends in this, let's call it a subsector, are?
Yeah.
What are the other things that people should be thinking about from an overarching perspective?
Yeah. I think from an overarching perspective, another thing that we've maybe done that I think maybe changes the paradigm of how the investment should be done is that a lot of people, when they were looking for sustainable investing, they were looking for projects. They were looking for one infrastructure project here or one kind of education project there. It was a project based approach to investing, and I think that's fine. There's definitely projects that should be financed, that can be ring fenced, can be created as a special purpose vehicle and have no recourse to any other kind of balance sheet or sponsor, and be self-contained in both the revenues and the financing and the ultimate how the profits are distributed. But it's not enough. And people talk about this all the time. There's a lack of projects because there's not enough projects that in emerging markets that have already been completely costed out. Feasibility studies are done, offtake agreements are done, environmental social studies are done. There's a lot of upstream work that needs to be done for those projects to exist. That's one. And second is that even if they do exist, often the projects in developing countries are smaller than the ones in developed countries. And because of that subscale, they'll never have the ticket sizes that are needed for those large institutional investors that manage the trillions of dollars of assets under management. So it was just a fundamental constraint that was kind of clogging up the pipes for money to go to places where they're needed. We took that away by saying, well, you know where else there's a lot of opportunity? Just plain old corporate financing. Financing the general balance sheet and budget of either governments or corporations that just want to do their business and grow, and by growing, serve the underserved in their communities. But how do we ensure that then that's different from just conventional financing? And we said, well, okay, what if we shift the lens of analyzing a project and we take it and put it on the overall entity? So we say, okay, if an entity, let's say a company, let's say a cell phone company in Tanzania, meets a certain standard of impact measurement and management, and kind of ahead of time, ex ante, discloses plans for expanding in a way that is sustainable, it's responsible, it's inclusive, it's meeting the needs of the underserved, and it's ultimately addressing development gaps. If they meet a certain threshold of doing so, then their full balance sheet, their entire corporate financing, their mainstream banking should be eligible for sustainable finance. We thought that as a much more scalable solution than creating another labeled instrument and painting it, I don't know, orange, and then saying, okay, now this is a new asset class for development. Provide financing to those that have committed to addressing the development challenges in their country through mainstream channels if they meet a certain standard of impact measurement and management.
Okay, so it's a little bit like where ESG went from an investable product to more like a screen for all products.
Right, right.
Okay,
And this will now become a screen for all entities.
right.
And once that entity is seen to be addressing and advancing the sustainable development goals, then that entity should be eligible for sustainable capital for their equity, for their debt, for their revolving credit facilities, for their trade finance facilities, for their corporate derivatives, for whatever they're doing that ultimately helps them finance their business and grow, whether it's going to OPEX or CAPEX or to a ring fence project or whatever it's going. As long as they meet a standard of transparency on their impact, then it is sustainable and should be eligible for sustainable capital. Now, again, different investors will have different criteria, and there's going to be some that say, no, I only want to still invest projects, and that's fine. If that's their mandate, then that's what they should do. But we think this broadens the aperture to bring in more sustainable investment opportunities to market. And what's really interesting, Rob, is that in my conversations with investors, what I hear is that it's the lack of supply that is the constraint. It's not a lack of money. A lot of people think, oh, there's a $4 trillion gap to financing the SDGs. There's probably not enough money. No, the money actually says that, I have more demand from people who, pension funds and whatnot that want to give me money for sustainable investing in emerging markets than I have places to deploy that money. So the problem is a lack of supply. We think that this approach will really increase the supply into the market.
All right, so can you, at this point, I know this may be impossible, let's just take a crack at it. Can you forecast how much that might close that gap?
Yes. So the first order effect, we think, and this is just by taking the volume of transactions that we at JP Morgan evaluate to have development impact and grossing that up by our market share. We think that if this approach is adopted by the industry, it will bring over $200 billion of additional supply of development impact investment opportunities to the capital markets each year.
Oh, okay.
Right?
So
Each year
compounds.
on an
Yeah,
annual
yeah,
basis,
yeah. Mhm,
200 billion.
mhm.
And that's the first order effect. We think the second order effect is that if this increase in supply then allows the investors to grow existing funds, right now the total amount of assets under management for sustainable investing is about $3.5 trillion. Yeah. And they're telling us it's a supply side constraint that we're not growing that number. So if this additional supply then motivates them to increase the assets under management for sustainable investing, then there'll be more incentive for the issuers to issue even more sustainable investment opportunities. And so that could have a virtuous cycle that can grow you from the couple $100 billion to orders of magnitude.
Yeah, and just thinking about that in terms of size at 200 billion, it might only be a couple of years before you start to address in a meaningful way the scaling problem, right?
Yes,
So
exactly.
that's fascinating. So are there other trends that you anticipate?
Yes. So what we really see this, Rob, is a bit of an ecosystem play, right? Like we are bringing all of the different players into this space to kind of build this ecosystem, scale things up. And this ecosystem is going to need some other components as well. For instance, it's going to need market infrastructure. So currently, all of this data on impact and everything, we've been putting it on a PDF on a page and emailing it to investors
Right.
and whatnot. And there's a limit to the scalability of that approach. So we're thinking about now building an impact data platform, which will digitize this information, which will make it much more easier for the investor side to filter and search through. If there's an investor sitting in the Netherlands and says, I really want to invest in companies that are advancing food security in West Africa. They could just punch it now into this platform and see any companies that have meaningful metrics and targets and accountability and transparency to reporting progress on advancing food security in West Africa. And then they can, go to their, dealer, investment bank and ask, hey, do you have any securities from these type of companies? And we can either originate and sell it to them, or we might be already in the process of already doing so. So I think that market infrastructure is one trend. I think another one is a whole suite of third-party services. At the end of the day, I think a fundamental cornerstone of what impact requires is trust, right? Like you need to be like, yeah, this is really having a positive impact. And, obviously transparency on the reporting of the person who's getting the money is important, but then you want typically independent verification. You want monitoring and evaluation. You want to know, was it that company's specific activities that had a causal effect on those impacts on society that were generated, or was it just luck, or was it something else? So, you need some more detailed analysis. You need to kind of poke the theory of change that is being claimed that the output of one company is going to lead to certain societal level outcomes. You might get academia involved to test those theories with a variety of research that they do. You're going to need benchmark indices to be created that have impact as a criteria for inclusion in that index methodology, so that the asset manager can have a relevant index to benchmark their portfolio against. So you're going to have a variety of analytics products and things like that. So there's a whole kind of suite of third-party services that are going to need to be developed around development impact investing in capital markets that, again, through this effort we are already working on, but we think that, we invite any one of your listeners to really reach out to us and engage with us as we build this out, because it's, again, it'll take a village.
Right, and that's a business idea, folks, right there. That's how CFA New York's podcast delivers value. Arsalan, this has been fascinating. Thank you so much for the insights. There's a lot more to learn here for most of the members, I'm sure. So, but you all have done a lot of work here. It's really interesting. So congratulations.
Thank you so much, Rob. Thank you for having me. And to all your listeners, exactly, if they want to learn more, they can look up impact disclosure guidance on the web, and I'm sure there'll be more material that they can find to seek out.
Very cool. So, and thank you all for listening to this podcast. Now, before you go, particularly members of CFA Society New York, we've talked a little bit here about some of the sustainability issues, and many people know that heating and cooling structures are two of the major contributions to carbon production globally. On October 17th, CFA Society New York will have an event that will dig into some of the new technologies that building owners can use to optimize their HVAC and other functions, to be greener, and to manage expenses, which is exceptionally important in subsectors like office. So if you're interested in hearing about those technologies, please register for that event on our website. Until next time, I'm Rob Rowan, and this has been Compound Insights.